All right, ladies and gentlemen, distinguished guests and esteemed speakers, welcome to the Moneycontrol Global Wealth Summit 2025 in Mumbai. The city's relentless energy makes it the perfect stage for gathering the brightest minds in markets, business, and policy. It is now our privilege to introduce Howard Marks, co-chairman and co-founder of Oak Tree Capital Management, a legendary investor known for his contrarian thinking, deep insights in market cycles, and expertise in value investing. His famous memos are widely read by top investors, including Warren Buffett. Please welcome Howard Marks and Mahalakshmi Narayanaswamy of Moneycontrol for this conversation.
What is different this time, in your view? I know that you hate to do predictions, but probabilistically speaking, it looks like stocks will underperform bonds, inflation, and cash over the rest of the decade. What's your view?
What's different this time, if anything, is the constitution of the S&P 500. We have the Magnificent Seven. It appears that some of them, or if not all, are some of the greatest companies we've ever seen. Better than the companies that led the S&P in the past. But I think that it's hard to argue that the S&P is positioned for above average returns, and maybe not today even for average return.
Howard, how do you think Trump's policies are likely to reshape business and financial markets globally?
You know, I would say in general, this is a vast overgeneralization. The Republicans would agree and the Democrats would disagree. And certainly today there's a whole element in the Democratic Party which thinks that business and free enterprise aren't such a great thing. Donald Trump thinks they are, and he will try very hard to make business do well and American business do especially well. But some of the actions can have short-term negative effects. For example, the tariffs, which he thinks will, discourage imports and encourage exports and produce revenues for the government to balance the budget. All of that seems like great things, but they should have an inflationary impact.
Sure. China has been waiting for a recovery for nearly 3 years now. It's not happened. To you, Oak Tree, what is your view on China?
Look, I think that China has great potential. It has great human resources, educational resources. It's very purposeful, and it is highly motivated to become the biggest economy in the world. India, on the other hand, has a growing population, and coming off a low base, it has incredible opportunities. And of course, you have a very constructive government right now, which is trying to move this country ahead. My last visit here was exactly 8 years ago. I feel a different energy today. India seems very positive, but of course, you have a large sector of this large and growing population that you have to move into the middle class. You have to educate with skills. You have to get jobs for. And you have to increase your capital base. Different challenges, but hard for me to say better or worse right now, especially because of the geopolitical overtones. Many people have described China as uninvestable. I think people inherently want, the term the BRICS was coined 30 or 35 years ago. And I think everybody who's optimistic wants to have some money in some subset of the BRICS. I think India seems to be a great candidate for that right now. And in fact, of course, India has benefited from the fact that so many people see China in a less positive light today.
Thank you so much. On that note, Howard, that's all we have time for. But thank you so much for this opportunity. It's been a real privilege and honor. Thank you.
Well, thank you for your good questions.
Global investing is being reshaped in real time with Trumponomics, a mix of tariffs, tax, and America First policies redefining the capital allocation. Let me welcome back Mahalakshmi on stage for a conversation with our special guest. It's Mark Coombs, CEO of Ashmore Group.
So, first things first, what is your view on Donald Trump's policies?
I think the problem with policy is that people like certainty. Investors like certainty and clarity. And so at the moment, we've got a situation where nobody is quite sure what degree of tariff may or may not be charged on whom for what kind of sectors. So in terms of the idea of tariff, I mean, there was a world years ago when it was all tariff and no tax. The tariff was the tax. That's what happened in terms of the US, and that's a little bit how we believe Donald Trump is thinking. I think things need to settle down. We need to understand at what point tariffs are set to come into force and remain with a degree of permanency, as opposed to a geopolitical negotiating tool.
And what do you think will be the impact with respect to China and India?
Yeah, that's a really good question. I mean, you see that fear moving around with flow. If you think about not just domestic investors in India, but you think about global investors trying to pick the winner between India and China. I think it's going to depend on a few things. I think if you're the American president that currently sits there, you would regard China as your greatest competition. You may or may not be right in the long term, but clearly China plans to be the biggest economy in the world and has made no bones about it and plans to exercise that any way that it can over the long term. If you're not a Chinese investor, that makes it quite a difficult place to invest from time to time because you're not certain about policy. It is relatively opaque in the way that it operates. Yes, it's big. It has some big structural challenges at the minute, not least massive youth unemployment. And it's going through a difficult reset. Does it long-term do better than it is now? Almost certainly. Is it in the price? Some people would say yes. There's been a big shift out of Indian equity into Chinese equity, for example, having been the other way around for a couple of years. I think the way we think about it is, and I said this right at the start, you want to be in countries that are that you're relatively certain of what the policy is. Business will work it out. If we know what the rules are, and as long as there are rules and a rule of law to enforce them, we'll figure out how to invest and where to invest. We can absorb a tariff here, a tax rate there, a particular incentive to stimulate tech in that place or not in the other place. But we require certainty. So for me, in terms of long-term structural investing, I want a place that has that and where capital can flow relatively freely. The challenge for non-Chinese investors now looking into China is, yes, the stock market may be relatively cheap and one can trade that, but to be a very long-term structural investor is quite difficult if you're not certain what the rules are going to be if you're not Chinese and if you're from overseas. So what I think you're seeing at the minute is the relative attractiveness of India. Geopolitically, we can get into, but even economically, where there's certainty of policy and there's some structural reform going on here and the whole move to digitalization and bringing more people into the net, it's a very attractive place to invest if you were doing a straight one-to-one comparison, not just on scale, but on certainty and on terms of rules under which you can operate and invest for the long term. As investors, we can trade everything. That's all jolly good fun. But what really helps us is not day-to-day and second-to-second trading, but being able to commit capital for the really long term and then trade around the margins. But you want to be long and right and then trade around the margins. What you don't want to do is have to keep going, oh my goodness, they're going to shut the gates on capital flows, or they're going to start saying they don't want foreign companies, or they're going to start saying healthcare should no longer be a private sector business. These are things not happening in India, but they are the risk in China. So for me, structurally, India is more attractive long term. China's, of course, massive and will be the biggest global economy. How you play that is much trickier without certainty.
Sure. That's all we have time for, Mark. It was absolutely incredible talking to you. Thank you so much.
Great. Thanks for your time. Thanks for listening to me. Thank you, everybody.
Amid rising geopolitical tensions and growing concerns over the strength of the dollar, gold is experiencing a dramatic resurgence. As India's second most owned asset class, gold has delivered a significant wealth effect for Indians. But how sustainable is this rise? Let's find out with Manisha Gupta from CNBC TV 18 and requesting David Tate, CEO, World Gold Council, to join us on stage, please.
David, I do understand that World Gold Council does not give out price views, but are you as bullish as so many banks and brokerages, because they're putting out much higher levels for this year and the next as well?
I know you would expect me to say yes, given my role, but yes, and the reasons are frankly not very obvious to many people, but becoming more and more apparent. I think pretty much every indicator of where gold should go is pointing upwards at the moment, but probably the most important thing is the burgeoning debt throughout the world. I think the global long-term sovereign debt has reached, I think, around about $76 trillion now, and is going to be added to by a further $13 trillion. And whichever way you look at it, we seem to be approaching, shall we say, through tariffs and inflationary push, which is going to steepen yield curves, in my opinion, which is going to make the reality of financing that debt very, very relevant to people. And I think the one asset class that always steps into that gap at that time, rightfully so, is gold. And I can't see an alternative to going higher.
You know, David, for the longest time, a lot of people, financial advisors for that matter, kept saying that gold is an idle investment, doesn't give you dividends. Look at some of the equity stocks or indexes for that matter, and they have given strong returns. But then look at last 3 months, and if you did not have gold in your portfolio, then you perhaps weren't recently leveraging it. Near term, yes, we've seen the gold prices gain up, but with the kind of scenario that we are in right now, macros, geopolitical tensions, tariffs for that matter, do you see gold prices holding these kind of return on investment for a longer term?
Yes, I do. I think it's an important thing to have as part of a portfolio, and very few people, and we are trying to change that phenomenon, truly understand that. To have gold, as you heard a speaker earlier, Mark, mention, to have gold as part of a portfolio and raise it and lower it depending on your view of the world is critically important. If you do not have gold as part of a portfolio, you're very likely to fall foul of the geopolitical, geoeconomic problems that we're seeing at the moment. For instance, even if you were predisposed to hold Bitcoin as part of your portfolio, which I'm not, but if you were, it's even more important that you have gold as part of your portfolio going forward. In fact, even the central banking community views gold as part of their overall portfolio, as importantly as individual investors should.
So as I was saying, India doesn't need a reason to buy, but the whole financialization of it and the way it is now included in portfolios in sense of ETFs and digital gold and sovereign gold bonds were a huge success as well. Do you see that change coming, and do you see that staying?
Yes, I think the sovereign gold bond was very, very successful for investors, perhaps less so for the government, but nonetheless, I do think that as your generations become more financially literate, you've got a swathe of young people out there looking for a way of investing in the financial markets, not least gold. I think that the instrument that will take the place of sovereign gold bonds is going to be gold ETFs. A little known fact to many people, ironic to me, I should say, is the fact that ETFs are gold-backed, 100%. They're listed, they're regulated, they are a very safe way of investing in gold. And as you've seen from the previous 2 to 3 presentations, the amount of money that is in this country and growing exponentially that is available to invest is an enormous opportunity for the ETF market. I fully expect to see that skyrocket, I really do, as people perhaps shift, and I say perhaps, shift from the physical gold investments into a more digital gold investment.
Thank you so much, David Tate, for joining us here. Really appreciate your time. Thank you, gentlemen.
Joining us next, our guest is a journalist and an author of not 1 or 2, but 7 New York Times bestsellers. And with his latest book, The Power of Regret, he's here to reveal why most successful people don't live with regret. Welcome to the Moneycontrol Global Wealth Summit. This is Daniel Pink. All right, thank you so much, Daniel, for joining us bright and early over there. Now, your book on regret has very different meanings for everybody. But here, every leader, every investor, every entrepreneur sitting in this audience has faced regret. So how do these people, the wealth creators of India, how do they not see regret as a failure?
Regret is that feeling that we have when we look backward and wish we had done something or wish we hadn't done something. It's a painful emotion. And our goal, what we might think, is that we want to avoid regret at all costs. And that if we feel regret, we should just ignore it because we don't want to wallow in it. And that's not quite right. What we should think of is that regret is an emotion that is functional. It's adaptive. It has a purpose. But you don't want to have only positive emotions. That's not diversified enough. And you want to have some negative emotions because negative emotions are functional. So would you want to if I offered anybody in this audience an operation and said, I will eliminate fear, you will no longer experience fear, which is a negative emotion. Don't take that offer because fear is functional. You want to get out of a burning building. Think about something like grief. Grief is functional. It reminds us why we love. And so the most prominent negative emotion we have is regret. And the reason that we have it is because it can help us make better decisions in the future.
That's fascinating. But in your book, Daniel, you've surveyed people, you've spoken to them. There are lots of patterns that have emerged. Could you point out for us if you've noticed any regional differences, for example, in how business leaders, investors show regret or face regret, say Silicon Valley versus India? Is there a difference in pattern?
Yeah, there actually are. So I collected regrets from over 26,000 people in 134 countries. And in part to answer that question exactly, we had the survey in multiple languages. And what I found, to my surprise, is that there were not that many regional differences. Very, very few. And when you look at business leaders around the world, what you see is their biggest regret is not being bold enough. Not being bold enough. Especially when you look at people's, so one is not being bold enough for business leaders, not being bold enough. I wanted to take this chance, but I was too scared to do it. And now I regret it. You have some people who act boldly and it doesn't work out for them and they regret that. But for every person who acts boldly and it doesn't work out, there are probably 40 or 50 who say, I wish I had acted more boldly. The other thing that you see sometimes with business leaders is some moral regrets. I wish, I was at a juncture in my career and I could have done the right thing or the wrong thing. I could have taken the high road morally or the low road morally. And most people, including most business leaders, regret over time not acting morally. So be bold and be good is really the lesson that comes from that.
Daniel Pink, thank you so much for joining us, for sharing your thoughts. And this book is one that provokes a lot of thought. Thank you so much. Daniel Pink, ladies and gentlemen.
Thank you.
Psychology plays a crucial role in financial decisions, often leading to irrational choices driven by emotions, biases, herd mentality, even regrets, causing investors to overreact to market fluctuations, chasing trends or holding on to losing investments longer than necessary. Understanding these psychological traps is key to navigating the complexities. And to take this ahead, let me now bring up on stage Prashant Nair for the next discussion. And who better to talk about psychology than Morgan Housel?
We've had in India, Morgan, I think the US is starting a bit of a wobbly, it's had a few wobbly sessions now. In India, of course, the market topped out in September. We had a painful correction, and now we're finding our feet once again. And a lot of people, when they are asked to describe what kind of market we had, they use this term, we had a narrative-based market, right? Stories, narratives. And I think it's a topic you touch upon in your writings quite regularly, that at the end of the day, investing is storytelling. It's a number now multiplied by a story in the future.
Yeah, it's always the case that markets are narrative driven and the narratives change all the time. And I think sometimes we want to pretend in investing that of that equation, every valuation is a number from today multiplied by a story about tomorrow. We want to pretend that the number from today is the most important part, because it's what we can quantify, it's what we can look at. But the truth is, the story that we tell ourselves, positive or negative, is always the more important thing. And now, not to get too technical, but the lower interest rates are, the more powerful that story is. And for a lot of the last decade, at least in the United States, we had 0% interest rates. So the story was everything. And particularly in a social media driven world, the stories that people can tell themselves get ridiculous. Because no matter what you want to believe in investing, somebody is on Twitter saying it. You can find that narrative anywhere, and it creates a situation where the wildest stories, the craziest stories, just grab a holding and go and run away. I mean, look at Tesla, for example. Tesla makes a tiny fraction of the number of cars of Volkswagen, Toyota, General Motors, go on the list, but it's worth 20, 30, 50 times more than those other car companies. The other stat I saw the other day is that Ferrari makes 13,000 cars per year and is worth $90 billion. Volkswagen makes 9 million cars per year and is worth $40 billion. The difference between that is overwhelmingly just narrative. It's that Ferrari is fun and whatnot. There's different narratives involved. And I think this throws a lot of people for a loop if you are like analytically minded and you want to think that the world should work in clean, rational ways. You think like a spreadsheet. Then this world will drive you crazy. And you constantly think that the world is either a bubble or just like losing. You're always confused about what's going on. But when you view it as a narrative, then it starts to make sense. Yes, things are crazy. Yes, a lot of things don't make any sense whatsoever. No, you can't put a statistic on everything that's going on in the world. And it's always been like that, and it always will be.
I mean, as someone said, I'm much better with someone who tells me broadly what's going to happen rather than precisely what's going to happen. I mean, that's the idea, right? And the other thing, of course, I mean, is it's a FOMO, fear of missing out. And it's a powerful sort of, it sucks people in. We've seen that here in India, right at the top. I mean, a lot of investors who write into us, ask us questions, and we say, well, show us your portfolio. And we look at the portfolios. There are a lot of stocks that we ask them, well, why did you buy it? There are no clear answers. I mean, there was that strong pull. Money begets money. And so that you can't resist it. It's just too strong. Just talk to us for a minute about that, because you write about that quite often.
Yeah, I think social media and just broader financial media makes it harder than it's ever been, because no matter how well you're doing, there is somebody out there who at least will tell you that they're doing better, whether they actually are or not. And so it creates this idea that you're always falling behind. And I think if there is one single financial skill that you have to have, absolute prerequisite to doing well over time, it's a lack of FOMO. You cannot do well financially over time if you're susceptible to FOMO. It's impossible. And really what FOMO is it's outsourcing your analysis to somebody else's emotions, is effectively what you're doing. You're looking at somebody else, some other asset class or some investor, and you're saying, they're doing better than I did. I need to catch up with them. You can't outrun that train. And so I think there's so many different financial skills that are important over time. The base of that pyramid, if you cannot control FOMO, you should give up at investing. It's never going to work.
But how do you get rid of it? I think everyone has it. One is born with it.
I think a lot of people have it. I don't know if everybody has it. There's a great quote from my friend Brent Beshore where he says, I am 100% happy watching you make money and get rich doing something that I have no interest in. And so I think you just have to understand what you're good at and what you're not. And if you can't describe what you are not good at, it's going to be very hard to do well as an investor.
Absolutely, so well put. And I think you bring out those stories so well in your books. And that's what makes your book so enriching, insightful, and entertaining. And I hope I get my daughter to sort of stay on the book and sort of ignite a spark in finance through your books, as I think all of us have done here. Thank you very much, Morgan Housel, for being with us here this evening. Appreciate it. Thank you very much.